Well, the elections are officially over, and with every election, almost 49% of the country thinks the world is going to come to an end. So it's a great time to ask yourself, are you taking the appropriate amount of risk in your retirement portfolio? Stay tuned to this week's episode of the Retirement Income Source, where it's all about the income. And welcome to the Retirement Income Source, where it's all about the income. I'm David Scranton, here with my good friend and co-host Sarah Samuels. And today we are talking about risk assessment, especially in light of the recent election. And like I said before, virtually every election, 51% of the world thinks it's fantastic and 49% of the world thinks the world's going to end. Great time to assess the amount of risk you're taking in your retirement portfolio and make sure that it's not excessive.
Yep. And Dave, of course, it's great to be here with you and with all of our listeners. And I know a lot of listeners are probably wondering, maybe I'm taking too much risk. Maybe I'm not taking enough risk. And, Dave, if our listeners could see you right now, I'm sure they'd also be wondering what's going on with all the bandages all over. Just so you all can visualize this, Dave's got a couple different Band-Aids on his face. I'm not sure what's going on here. It's a new look for him.
I didn't take my Halloween costume off yet.
I'm
sorry. I know it's been a couple of weeks. It's still on. Yeah. My Frankenstein look. No, dermatologist, they love to go and hack you up. So a couple times a year, you need to go get things chopped off, whether you need it or not. And my time was just a couple days ago.
Yeah, good. Well, that's important, Dave. It's good to, take care of yourself, of course. And for our listeners, it's important for them to take care of their portfolio and make sure that they have the right amount of risk as they're heading into retirement. So, Dave, let's go back to the basics here and really talk about the different types of risk.
Well, first of all, there's risk of a complete loss, which is typically if you're not diversified, you have a couple of holdings, maybe you're exclusively in one sector, risk of a complete loss, the investment utterly becoming worthless. But then you have risk of volatility. So if you're in a more diversified portfolio, the portfolio can go up or down in value. And then the question is, how far can it go down? What's a reasonable volatility range? And can you stomach that? But then there's other types of risks, like inflation risk, right? You could have your money under your mattress and you're not going to lose anything, but guess what? It's losing money every single year due to inflation, because next year, I could promise you one thing, Sarah, that money under the mattress will be able to buy fewer goods and services than it can right now. Yeah. Then you have liquidity risk. If you get into something that's completely illiquid, what if you have an investment opportunity that pops up and now you can't take advantage of it? So today, Sarah, we're going to address those 4 different types of risks.
Let's get into our first Ask Dave question, which really has to do with that first type of risk you mentioned, Dave, which is complete loss. So our question comes from Diane in Connecticut. She says, we invested in real estate on the advice of our financial advisor, but now everything is worthless. We were diversified, so we thought that it would never happen to us and we would never take a complete loss. What can we do now?
All right, Diane from Connecticut, I want to make one thing clear. As a host of the show who has a financial practice in Connecticut, our Ask Dave questionnaire, Diane, is not a client of Scranton Financial Group, past, present, or future. Maybe future, but I just want to make that clear.
Hey, maybe in the future you can make her a client.
That's right. Yeah. Maybe she should be given upon that.
But absolutely.
So, all right. Diane, what happened here? Well, I'm only going to guess, but my suspicion is your financial advisor puts you into probably a non-liquid investment. There are non-liquid real estate investment trusts where you're invested in real estate, but it's not liquid. So you put your money in and they promise in, let's say, 5 to 10 years, they're going to have a liquidity event. They're going to sell out. They're going to do an initial public offering, and you're going to get back your money plus a huge capital gain. But sometimes, of course, it goes the other way. Also, the other thing that you might have thought of is a real estate limited partnership back in the day. Those are popular in the 80s and 90s, right? Same thing, illiquid. Most liquid real estate investments aren't going to go to zero. It's not going to be a complete loss. So, Diane, the fact that you said it went to zero, I'm guessing, or became worthless, I'm guessing that it is an illiquid investment. And I will tell you, I'm not a fan of those. Yeah, there's some investments that commit to time frames. bonds commit to a time frame, preferred, sometimes 50 years, annuities, right? CDs. Time frames are one thing, but they're still liquid. It just means you might have a penalty if you liquidate it. But if you're talking about an illiquid investment, Diane, I know it's maybe too little too late, but I'm a big fan of staying away from those. Because by definition, when you have lack of liquidity, if something starts to have financial trouble, you don't even have the opportunity to sell it at a loss because you're stuck there. And that investment might have been diversified amongst many different properties, but it might have been managed by one manager, is my guess, and that manager failed in their job to manage the real estate investment appropriately. So stay away of things that are completely illiquid is a great general rule, in my opinion.
And Diane, thank you so much for sending in your Ask Dave question. If any of our listeners or our YouTube viewers have a question, something that you would like to ask Dave, all you have to do is send us an email to askdave@retirementincomesource.com. You may hear your question answered on a future show. You're listening to the Retirement Income Source, where it's all about the income. I'm Sarah Samuels here with David Scranton, and in the wake of the election, a lot of people are maybe reassessing their portfolio. They're taking a second look, maybe wanting to make some changes. And one of the things you want to take a second look at is, of course, your risk and the types of risks that you may be taking. So, Dave, we mentioned there's 4 main types of risks that we're talking about today: the risk of complete loss, risk of volatility, the risk of inflation, which everyone faces, and of course, the risk of liquidity when you're not liquid and you miss out on making an investment.
And what's interesting is Diane took really 2 risks. She took the risk of a complete loss and liquidity risk. And sometimes those illiquid investments, those real estate investment trusts, now, and those publicly traded real estate investment trusts, which are fine if you have the right advisor who can parse through those because they're liquid. But then there's the illiquid ones, the private ones. So why do they seem attractive? Why do smart people like Diane get into these things? It's not a stupid idea to get into them. So why do they get into them?
What's the benefit here?
Well, the purported benefit to the investor is that you have something that doesn't have a lot of volatility. The price is pretty stable from year to year. But frankly, the reason the price is stable is because it's illiquid. So it's not driven by market forces. Every couple of years, they need to get appraised by a third-party appraisal, come up with the value. So if you look at the volatility of the price per share, it's not as volatile as something that's actively traded in the market. Actively trade in the market means that the market participants daily determine the price of it, and it can have a lot of volatility, but at least it's liquid. So it looks like it's got, on the surface, though, it has less volatility risk, but that's because you're taking a greater risk of a complete loss. Now, the real thing that's in it for most financial advisors is a commission, a big commission. You see, we talk all the time on the show, Sarah, about how there's 2 types of advisors: those that are held to a suitability standard, and those that are held to a fiduciary standard, right?
And there's a difference between the two, a pretty big difference.
There's a big difference. So your average broker is just on a suitability standard. They have to make a recommendation that's suitable for you. Can't be terrible. It's got to be at least okay.
Sort of good, right?
Sort of good.
What if your doctor could just make sort of good recommendations? That would be great.
I wonder about mine sometimes. All these Band-Aids and cut marks. Maybe I need a doctor as a fiduciary, right? But when they have to make a decent recommendation if they're just held to a suitability standard. But that means that they're getting a commission, and sometimes the commissions are significant in these. Those that are held to a fiduciary standard are charging a flat fee. And usually they won't include these types of things in there because they don't want to charge a management fee for something that's illiquid and by definition cannot be managed. So there are different types, though, Sarah. There's different types, other places than just these illiquid real estate investments where you could take risk of a complete loss. And coming up, we're going to talk more about other places where you could take risk of a complete loss, as well as where you might have to end up incurring this dreaded volatility risk. So stay tuned. I'm David Scranton here with Sarah Samuels, and this is the Retirement Income Source, where it's all about the income.
Welcome back to the Retirement Income Source, where it is all about the income. I'm Sarah Samuels here with David Scranton, and today we are talking all about risk. And no, we don't mean risky behaviors, how you feel about bungee jumping, for example. We're talking about the types of risk that you may be taking in your portfolio and how that risk tolerance should change as you get closer to retirement. So, Dave, we've talked a little bit about the risk of complete loss, and you answered a great question from Diane. We've also, we're going to talk more about risk of volatility, inflation, and liquidity. But when it comes to complete loss, you guessed from Diane, who sent in an Ask Dave question, where she mentioned she invested in real estate. And you guessed from the question, it seemed like she had invested in a non-liquid type REIT, which a real estate investment trust, which was a big problem. But where are some other places that you could potentially suffer this complete loss?
Yeah, one of the big places today that you have to think of is cryptocurrency, right? And, who knows? I mean, it's funny how the Monday morning quarterbacks are, right? Crypto takes off and is permanently something, and a lot of believers in that camp. Then those who didn't participate, so you should have known. This is so obvious that we were in need for a currency outside of fiat currency, paper money, right? Yeah. But there's a bunch of other very smart people who think it's going to go to zero because there's nothing backing it up. There's no company that's making profits backing it up. It's not like a commodity where there's an underlying demand for it. You have underlying demand for all the metals, platinum, copper, silver, but not for crypto. So if it goes to zero, then the Monday morning quarterbacks will say, well, you should have known, right? So can it go to zero? Sure. It certainly
You think
can.
At this point, I don't know, Dave, because I think, a lot of the governments have gone to the idea of a central bank digital currency. I feel like we as a society maybe are moving towards it,
We might be, but that's different from, Bitcoin and Ethereum and all those. So
a lot of those fly-by-night
yeah, so maybe
and
Bitcoin's big and Ethereum's big, but maybe there's not a place for those, right? You don't know. And I'm not saying that's the case because I don't know what the future is going to hold, but the point is that that's an example of where you can, to have a total loss. The other thing is let's say you bet on a tech stock right now. Tech is hot, so you bet on a high-flying tech stock or a company that's coming out with a cure for cancer, right? Well, you own one company, one stock, or two or three stocks in the same area. It could fail, it can go bankrupt, you can lose all your money. Yeah. I would argue even if you went and diversified amongst the chip stocks, right? The chip stocks are hot right now with NVIDIA and advanced micro devices and all that stuff. Sure, you can do that and you could diversify amongst those. But what happens if down the road something replaces chips altogether?
Right.
Now maybe
the
you've
whole
lost.
sector would be wiped out.
Whole sector. Yeah. I mean, think about it, right? VHS tapes got replaced by DVDs, got replaced now by downloading movies and streaming.
Or watching them streaming.
Now we're streaming them, right?
So you don't even own it anymore.
Right. So who knows if eventually within 10 years chips won't even exist anymore and all these companies go the other way. So again, it's really that risk of total loss is due to lack of diversification is the bottom line.
Yep. And the right kind of diversification, not just within one sector, like you mentioned.
Right.
Let's get into our next Ask Dave question. We have a question from Bill out in California. He says, I'm diversified, so I'm not really as worried about a total loss, but how can I figure out if my risk from volatility is appropriate?
All right, Bill, writing in from the land of the earthquake, right? So you know a thing or two about volatility. I guess depends where you are in California. But so how do you know if you have the right volatility risk? Well, that's a great question. And so first of all, Bill, I don't know anything about you. I don't know if you're retired, if you're not retired. But one of the biggest mistakes that people make is they look at the last time we had a major drop. And I'm not going to say the pandemic, that was a major drop, but the government started infusing money and taking action so quickly the markets came right back. So to me, the last time we had a major drop was really 2008, 2009. So we're talking at this point over 15 years ago. And Bill, you, like just about everybody here listening to this show, was at a different stage of your life then from what you are today. So it's one thing to say, oh, that didn't even bother me back then. Because back then you were contributing to your 401k, you were younger, you're putting money away. Maybe you didn't pay attention to it. Maybe you didn't have a lot of money in there. You were dollar cost averaging, so you're buying more shares now and the market's down. It could have even been a good thing, right? So you have to look at it at this stage of life where you are right now. If you're retired, if you're close to retirement, and how much of a drop you can reasonably incur. So Part of it's emotional and part of it's financial. So you know that the most you could take, if you're a regular listener to the show, Bill, you know that the most I say you could take is 4 to 5% of your portfolio a year. So if you have let's say $1 million portfolio, to use a round number, the most you could take is 40 or 50,000 a year of income. And that is if you're allocated properly for income. So you have to be perfectly allocated to squeeze that much income out of a portfolio. So you can look at your portfolio now and say, do I have enough? Or how much can I lose and still generate enough income for me to live in retirement? And that would be a big part of it. But that's the left brain mathematical part, right? But then the right brain subjective part is more about how would I feel? Okay, so maybe the math says I can lose 20% of my portfolio or 30% and still at 4 or 5% generate enough income to live in retirement. But how would I feel? If my $1 million went to 750, would I still be able to enjoy my retirement, or would I be a nervous wreck every time I tried to put something on my Visa card, right? And then you got to find your comfort zone where, gee, if it goes from $1 million to 999,000, yeah, I'm okay. But if it goes from $1 million down to 1,000, I'm not okay. Well, then how about 998 and how about 2,000? And find that sweet spot in the middle where you say, you know what? I can sleep with that. I can live with that. So Bill, so I hope you can listen to the rest of our show today. We're going to be talking about this a lot more, but hopefully that at least helps you to some degree.
And thank you, Bill, for sending us your Ask Dave question via email. And if you have a question, maybe you're wondering something about today's show, wondering about volatility risk or all of the other different types of risks that we've talked about so far, please send us your question via email to askdave@retirementincomesource.com. And thank you for listening to the Retirement Income Source, where it's all about the income. I'm Sarah Samuels here with David Scranton, and we are talking about risk. A lot of people are wondering, hey, how can I determine my risk? What are other types of risks? What am I looking at potentially here? And so far, Dave, we've talked about the risk of complete loss, and we've talked about the risk of volatility. And you answered a question from Bill, who mentioned, hey, how do I even start to figure out if I'm at a good area for the way that I feel? And it's emotional and it's financial. It's two parts to it here.
Yeah, so the mathematical is easy. It's okay how much can I lose and still take 4 or 5% of that and be okay in retirement. But then the second part of it is, hey, can I sleep at night? Will I enjoy my money? There's I always talk about my Bernie Madoff story, right? About 2011, I think it was, or 2010, when Bernie Madoff had first gotten found out to be a crook, essentially. I was down in Palm Beach proper. Worth Avenue, for those of you who aren't familiar, Worth Avenue is like the Rodeo Drive of Palm Beach, Florida. And it was a Saturday afternoon, usually bustling with people shopping. All the rich people live there, right? I mean, a lot of billionaires with a B. But nobody was there. Nobody was shopping. And it seemed strange. And the reason, which I really finally figured out, was because Bernie Madoff had virtually everybody in Palm Beach as his client, but nobody was dumb enough to give all their money to Bernie Madoff. I shouldn't say it that way. Maybe there were one or two, but most people weren't. Most people diversified, right? Because they don't want to have total risk of loss. They want volatility risk. So they could still afford, they may have lost a part of their money, they could still afford to shop at Palm Beach, right? If you're worth $100 million and Bernie Madoff had a third of it, right? Now you're down to 67. Well, at $67 million, I'm pretty sure Sarah Samuels could shop on Worth Avenue, right?
Hey, yeah. At that point, I think my lifestyle would have grown to accommodate that. You would think at $67 million, you'd still feel comfortable enough to go out and shop. But these people didn't. Even if they lost a third, they felt that loss so deeply that they were huddled at home almost, like there's a storm.
They didn't feel, that's right, exactly. They didn't feel comfortable spending the money they had, because mentally, we don't feel good about a number. We feel good about the direction from which we're passing through that number. These same people, Sarah, when they hit 67 million on the way up of net worth, or whatever number on the way up.
That was great. That was the most they were worth at that time.
Yeah,
right?
and they were spending money on Worth Avenue. Yeah. But when they cross it on the way down, they don't feel so good about it anymore.
Yeah.
And that's the reason why, risk is so important, not just from a mathematical standpoint, but from an ability to enjoy your money standpoint. Every time you want to charge something on the Visa, take a trip or whatever, you don't want to be stressed out, worried about it, and feeling irresponsible.
Right. That's how retirement should be. It should be fun. You should enjoy it. And that's one of the risks that you run if you're invested in things that are too volatile, if you're running that risk. But we're going to continue to talk about risk, including the risk that everyone is facing, even if you're one of those people like Dave mentioned who has all of their money, their gold bars stored under the closet. Right now, you are still facing this risk, and we're going to cover that. I'm Sarah Samuels here with David Scranton, and you're listening to the Retirement Income Source, where it's all about the income. Thanks for listening to the Retirement Income Source, where it's all about the income. I'm Sarah Samuels here with David Scranton. And sometimes you might be thinking, hey, maybe I'm risking too much. Maybe I'm not invested in the right way. You may be wondering, what are the different types of risk? That way you can really determine if you're prepared to face those risks. And today we're covering 4 main types of risk, including risk of complete loss, risk of volatility, risk of inflation, and of course, risk of illiquidity. Dave, so far we've talked a lot about complete loss and volatility, but when it comes to volatility risk, how can our listeners help reduce that risk?
Right. So assuming that you're diversified enough so you don't have the risk of complete loss, you're diversified with at least, let's say, 20 to 30 holdings at least, but diversified also across sectors, not just all in one part of the economy, right? Then you've moved from risk of loss to risk of volatility. So now how do you reduce that volatility? Well, or how much volatility do you have in the market? Well, if you're broadly across the market, let's say the Standard & Poor's 500 index, you can lose 50% of your money at some point in the future, right? I mean, we've had it happen twice so far this century, since the year 2000. And Sarah, the fact that it happened twice tells you it can what?
It can happen again.
It can happen again, right? So that's the baseline, 50% potential loss. So if you want to stay in the stock market but lower it, then you go to high dividend value stocks, where in theory, if the market can drop 50, maybe the more conservative high dividend value stocks might only drop 30, let's say. Okay, so now you've reduced your downside a little bit. But what if a 30% drop is too much for you because you're retired or close to retirement, and that's too much to stomach? Well, now you have to start integrating bonds or bond-like instruments. In other words, things that don't have as much volatility and things that generate typically a fixed interest payment or a fixed dividend payment, right? Bonds pay a fixed interest payment for the life of the bond, and preferreds pay a fixed dividend payment for the life of the preferred. Different from a common stock where companies can increase dividends, but they can also cut dividends, right? So now by integrating some of these other things, you can lower that overall volatility risk. And you can get the risk down in those types of portfolios. Let's say my best gut instinct, Sarah, would be probably about a 15% downside. So that, the most you'd see with the downside of 15%. Now, if you want to go even more conservative than that.
What if you want close to 0%? We can't say 0% risk.
Then you've got bank CDs. Then you've got, certain types of fixed annuities. They're all contractual things that are time frame committed. That's right.
Yeah. Okay, makes sense. Well, let's get into our Ask Dave question. This comes from Jerry in Tennessee. He says, Dave, I know you mentioned in the past that bond funds are problematic, but you mentioned that they can also lower your risk. So I'm a little confused. All
right, Jerry. Well, so there's a difference in bonds and bond funds, and I define it periodically on the show, but I can never repeat it enough. So I'm glad you asked the question. I mentioned that when you buy a bond, you have a fixed interest payment for the life of the bond. But we also have, when the bond matures, a fixed date at which it repays you all the principal. So if you can buy a bond and hold it to maturity, you know exactly what you're going to get in terms of interest payments and a repayment of the face amount at maturity, provided, of course, that the company hasn't defaulted on its debt or gone bankrupt. So how do you get rid of that risk, right? Because that's risk of loss, absolute and complete loss. Well, that's if you buy a bond through one issuer. So you diversify, you buy bonds through maybe 30 different issuers, and now you've essentially eliminated that loss, right? If 30 major diversified issuers go bankrupt, chances are we've had systemic financial failure in our country, Jerry, and even the green piece of paper in your pocket are going to be worthless, right? So if you buy individual bonds and you diversify, you pretty much know what you're going to get, right? Where do bond funds differ? Well, bond funds eliminate those two guarantees, right? Because when you buy a bond fund, your interest payment can and will fluctuate. It changes. It can go up and it can go down. And also, there's no fixed maturity date at which a bond fund guarantees that it's going to pay back a full face amount, right? Because bond funds go on forever. So the two important guarantees that make bonds attractive as a more conservative tool for retirees, those two guarantees, Jerry, are completely off the table when it comes to bond mutual funds. In fact, if you were to study for your license to become a financial advisor and looked at the definition of a bond fund, you'd learn that it's defined as the stock of a company that owns bonds. So, Jerry, you don't even own the bonds. You literally own the stock of a company that owns bonds. Right then and there, by the definition, you know it has more risk.
Jerry, we appreciate you sending in your email with your Ask Dave question. Dave loves to go over the difference between bonds and bond mutual funds. It's incredibly important because a lot of people think it sounds similar, but they are two very different things. So if any of our listeners or our YouTube viewers have a question that you would like to ask Dave, get Dave to clarify something for you, we would love to hear from you. Send us an email to askdave@retirementincomesource.com. And we appreciate your time here with us today on the Retirement Income Source, where it is all about the income. I'm Sarah Samuels here with David Scranton, and today we're talking about the different types of risk because a lot of our listeners, they might not be familiar with these four main types. We've talked about the risk of complete loss when you lose everything, essentially, the risk of volatility, whether you're just invested in one type of investment, maybe you're only invested in one type of sector, and also kind of looking at your own risk tolerance, Dave, and going down that sliding scale of risky investments, right? You kind of, when you meet with a client, you talk to them and really understand where they're feeling at each level. Right. Yep. Investing in each each type of instrument, essentially. Yeah.
So, like I said, I mean, if you're just across the market, you have the risk of a 50% drop at some point, and you have the risk of your income, your dividends get cut. And we talk every week about how total return has two components to it, right? The income and the growth, right? The income is the interest and dividends that get paid out to you, that you like rental income that you can spend or reinvest. And then the growth, the capital appreciation that you can't really spend, it's just a paper gain. Right. And so with stocks, you have two risks. Number one, your portfolio could drop in value. Number two, your income could get cut. Of course, your income could also go up over time with a stock portfolio if you own healthy stocks. But you've got to think that you've got 50% downside. If you want to go down a little bit in that, you can go to higher dividend value stocks.
If you want a little less risk.
That's right. Increase the income and also decrease the volatility, the downside. But if you want to get down more than that, you've got to introduce a lot of bonds and bond-like instruments. But the furthest down you can get is probably about a 15% max loss on paper. If you're diversified and you're in the markets. If you want to go below that, you have to go to contractual things that have no default risk. But then, Sarah, as you know, you have another problem. And if you're too conservative, which is another problem, by the way, you don't want to be too conservative, is sometimes you don't even have an inflation hedge, right? Yeah. So if you're still trying to grow your assets, the interest you earn on really conservative stuff may barely keep up with inflation. Or if you're taking that income in retirement, you won't keep up with inflation. So I understand that, we've been talking a lot today about controlling risk and not taking too much risk, which is a bigger problem because the markets have gone straight up for, 4 years now. But there's some people listening that, aren't taking enough risk, that should really take a little bit because you kind of have to. With people living longer and longer, Sarah, as you know, you have to deal with inflation for a longer period.
Yeah, inflation is one of those risks that everyone is facing. And you said it best, Dave, if you're not getting any growth on your investments, then you're in bad shape. If you are spending down your investments, you're using a withdrawal strategy instead of a true income strategy, then you're in big trouble. You're probably
bigger trouble, right?
Big trouble. You're probably going to run out of money if you live to a certain age, 30 plus years of retirement. That's a huge issue. Mm-hmm. But there are ways, of course, that you can prevent or you can really hedge against inflation, especially when you're investing for income. There's things you can do, like organically reinvesting those interest and dividends you mentioned, that paycheck, if you will, from your investments.
Yeah, and I know we need to talk a little bit more about that for sure, because inflation is like high blood pressure. It's the silent killer, right? High blood pressure is a silent killer in medicine. Well, the silent killer in the financial world is inflation, because you think you're earning money, you think your money's going up, you think you're doing fine, but what you don't realize is how insidious it is when your cable bill goes up and your electric bill goes up and your food bill goes up. And, maybe your credit card bill was $1,500 a month, or and that was it. And now all of a sudden it's $2,000 a month. And how did it creep up? Average bill, you pay it off every month. You don't waste money. How does that happen? That is inflation.
There's so much creep, but there are ways that you can help prevent against that you can build in a hedge to your investments now to hopefully prevent some of that pain from inflation. And we're going to cover that coming up. I'm Sarah Samuels here with David Scranton, and you're listening to The Retirement Income Source, where it's all about the income.
And welcome back to The Retirement Income Source, where it's all about the income. I'm David Scranton here with Sarah Samuels, and today we're talking about managing the amount of risk that you have in your portfolio. And, it's a really good time because we just got through the elections, and with every election, 51% of the world is happy, 49% of the country, I should say, not world, is dissatisfied, many of whom think the world's going to come to an end, and I'm sure it won't. But the reality is that a good time to assess the amount of risk that you're taking in your portfolio. So far we've covered the risk of taking a total loss in an investment and how to avoid that through diversification. Then volatility risk and how to measure volatility risk, what's appropriate for you mathematically and emotionally, and then how to manage that in the stock market, then also out of the stock market by integrating more conservative strategies. And then just now, before the break, started talking about inflation risk and how you can keep up with inflation.
Yep. And inflation is really the silent killer of retirement. It's like high blood pressure in retirement. And no matter what, everyone is dealing with the effects of inflation. And it can be so insidious as you see the bills creep up. You see your credit card bill get higher. You feel like you're not spending money. You feel like you're being smart and saving. But somehow the money keeps slipping out. And there's nothing you can do to prevent it except take some action now to build in some inflation hedges and help prevent against that now and in the future.
That's right. And it's funny, inflation risk sometimes and liquidity risk come hand in hand because it's like when, just think a few years ago, interest rates were rock bottom 5 years ago, and there were people buying 30-year treasuries at 3%. Well, you might say, well, I could sell the treasury at any time, but it's interest sensitive. So now that the yields have gone up significantly, that treasury is worth a lot less. It might be worth 70 cents on a dollar. So that's not technically liquidity risk, right, Sarah? Because you can sell it. But if you're selling it at a 30% loss, that's a problem. That's really liquidity risk and inflation risk kind of, going hand in hand.
Yeah.
And that's why you really need to be smart and strategic when you're trying to keep up with inflation. And because people are living longer and longer, you retire at 62, 65, you've got to plan on a 30-year retirement. Well, that's a lot of inflation, a lot more than people had a plan for 50 years ago.
Right. And people are living longer and longer these days, so you have to plan ahead.
Yeah.
Our Ask Dave question comes from Daryl in North Carolina. Daryl says, Dave, I know you've talked about crypto in the past, including Bitcoin. What do you think about using gold for an inflation hedge?
All right, Daryl. So you know that I'm questionable on the cryptos, right? That's good. So you're a regular listener, Daryl. That's awesome to hear. So gold. It's interesting. Gold is traditionally considered a good inflation hedge, right? But I'm a little skeptical, and I'll tell you why. Gold is a commodity, and gold is being used less and less for industrial reasons than ever in history before. And the idea with gold is it's scarce. So when you have inflation, in fact, we used to be tied to the gold standard before the 1970s and up till the early 70s, our currency. So therefore, we can only have so much currency printed as there was gold, right? Because gold's a finite commodity, so we were covered. When we went off that standard over 50 years ago, now we could print as much money as we want, and of course that's what causes inflation. So that's the reason why gold historically has been a good inflation hedge. I would contend, though, that with gold not having the same industrial use anymore that maybe it's had in the past, and with all the world currencies now being off the gold standard, that gold is no longer a suitable inflation hedge. Again, when you're talking about something like that, there are plenty of commodities that are a better inflation hedge, right? Think about soybeans, think about oil, think about things, things that people need to buy, coffee beans, right? Those are great commodities or commodities that potentially can go up with inflation because they're things that people buy. People don't need to buy gold, right? Most of the time, if you're buying gold, it's extravagant, it's in jewelry, and if there's a recession or high inflation, you might not buy it. So I hope you could stick with us for the rest of this segment, though, because we'll talk a little bit more about what I believe does constitute a good inflation hedge today.
Yep. And Daryl, thank you so much for sending us your Ask Dave question. And if any of our listeners have a question that you would like to send into the show and maybe have it answered on a future show, all you have to do is email us at askdave@retirementincomesource.com. You're listening to the Retirement Income Source, where it's all about the income. I'm Sarah Samuels here with David Scranton, and we are talking about all the different types of risks that you could be potentially looking at in your portfolio. And in the wake of an election, a lot of people want to reassess, realign, take a look at what they're invested in. And it's important to understand the types of risks that you could be facing, including complete loss, volatility, this risk of inflation that really everyone is facing. And Dave, you made a great point about why gold is not necessarily the inflation hedge anymore that people thought of it as in the past.
Yeah, and again, it was great when we were limiting the amount of currency that we could print to the amount of gold that exists. It had to be backed by gold. But now that hasn't happened, is it really an inflation hedge? Whereas at least there's other commodities that could be a better inflation hedge because there's a need for those types of things. But also, think about companies, right? Think about stocks. Like we know bonds are not a good inflation hedge, right? If you're in bonds and bond-like instruments, the only way to get an inflation hedge, as you said earlier in the show, was by not spending all your income, by reinvesting some of the interest and dividends. So now your income goes up each year. So that's a good way to get an inflation hedge. How to engineer an inflation hedge from an instrument that is not designed for inflation, right? Bonds and bond-like instruments. But it can work, and it's a conservative way to do it. The other way to get a great inflation hedge is if you're invested in stocks of companies that can pass through most of those increase in costs. Because, we all know when in periods of high inflation, the stock market doesn't do well, the bond market doesn't do well, none of the financial markets do well. But what the stock market has an ability to do is be resilient. Because if the price of the end good that a corporation is selling goes up, yeah, the cost of the raw materials goes up, but the price at which they're selling that good to the consumer goes up. So their profit should go up. So if you make a good that costs you $1 and you sell it for $3, okay, you have $2 worth of profits. You could pay out a dividend. But if all of a sudden inflation doubles it, okay, well, you could sell it for $6, but it cost you $2 to make it. So now, in theory, you make $4 worth of profit. Maybe you could double your dividend. But the problem with that, Sarah, is you've got to focus on companies that are good, that are well managed, that could pass through the inflationary increases to the consumer, the end purchaser, and that are well managed companies where the inflation, the increase in the cost of raw goods isn't going to bankrupt them.
Yeah. Well, that sounds pretty complicated, Dave. I mean, I'm sure another way that somebody could do it is maybe working with an income specialist, right, to make sure that they are building in these inflation hedges.
An income specialist can customize the inflation solution, right? For somebody who wants to take a bit more risk, go to those high dividend value stocks, but be very careful in the value stocks they choose, because some of the value stocks are down in value paying a high dividend for a reason, because they're at the end of the mature part of their corporate life cycle. So, they're other companies are taking their market share. They pay a high dividend because it's an illusion, because the price has just gotten beaten up. But eventually they're going to cut their dividend. The price is going to drop further. So you want to have an income specialist who can determine which of those high dividend value stocks is a good buy, is a good value, versus, as we call it, a value trap.
Right. Which is, and there's a big difference between those. I mean, if you're looking for an income specialist, someone that you know that can handle that, one of the great ways to find someone is checking out our main website, retirementincomesource.com. Click find an income specialist, and you can actually work with our interactive map to find someone in your area. And those are people that are aware of what are value and what are value traps.
And even if somebody doesn't want to take all that risk or wants some money in bonds or bond-like instruments, they can gauge the amount of income that you're taking and make sure there's enough being reinvested to engineer an inflation hedge. Because, some advisors, Sarah, unfortunately, they don't want to lose any clients. They want their clients to be happy with them, right? So the client calls up, goes, "Oh, can I take out an extra 20,000? Can I take out an extra 30,000? Can I increase my income?" And the advisors want to say no. And maybe they're afraid they'll upset their client because it's their money. The client's going to say, "What do you mean no?" So, but instead of educating them why they shouldn't take out more, they'll just say, sure. And the client thinks they're getting plenty of income, and they have no idea that income is coming really out of principle or at bare minimum at the risk of future purchasing power, inflation.
Absolutely. Well, we appreciate you listening to the show all about the main types of risk that you could be facing in your portfolio. If you would like to share the show with your friends and family, you can always check out all of our episodes at retirementincomesourceradio.com.
We hope you do that. And most importantly, we hope that you're here with us next week, same time, same station. I'm David Scranton here with Sarah Samuels, and you've been listening to the Retirement Income Source, where it's all about the income.